Hello and welcome to Flagstaff TV. Today we are joined by Simon Strong, who is Head of Technology at SP Angel. Simon, thank you so much for joining us today.
Thank you very much for having me on.
Now, looking at tech capital, it trades at a substantial discount to net asset value. How big is this?
Quite sizable. So Tech Capital is an investment company. So it regularly states its net asset value per share in its accounts. And as at 30th of June, it had about $70 million of net assets, and that equates to about 35 cents per share. So based on the current share price of 8 pence, it's about 70% discount to NAV. It's very substantial.
What has happened to the investment company sector, and why are discounts so large in some cases?
Well, prices normally trade around asset value. And in bull markets, they can trade at a premium. And bear markets, they can trade at a discount. But what happened in 2022 onwards, when interest rates started to rise, there was a drain of liquidity from the market. And that's been particularly felt in small cap stocks. And of course, AIM is dominated by small cap stocks. So there's two things that have gone on. There is the early stage investments have been marked down substantially, particularly those companies that necessarily have to raise additional capital to fulfill and fully exploit their business models. Those companies have been hit very hard. But also this drain of liquidity has affected all stocks. And so where you might find a 50% discount to NAV, that's normally associated with recessionary periods, and that's not what we're seeing here. We're not seeing a recession. We've still got positive economic growth in Europe and particularly where the US, where some of the tech capital portfolio is based. And so it's a combination of several different things, but it's an unprecedented level of discount, and illiquidity is one of those factors.
Now, tech has been successful at listing many of its investments. What's been happening recently?
Well, indeed, about 60% of its portfolio is listed, and therefore they have tangible market prices. Many of these investments themselves have been trading at 12-month lows because of the early stage of their development. So referencing what I just said, there is early stage companies that need to raise capital have found it very difficult to make headway with their share prices because there's always concern about having to raise more money. And so therefore there's a sort of double discount in the tech capital share price. So you've got the underlying investments, which are already at a very low price, and then you've got the tech capital share price itself trading at a very substantial discount to the market, to fair value for these investments. So that's why it's a form of double discount.
And Simon, what is Tech Capital's business model?
So tech helps commercialize intellectual property, typically the IP generated by research-based organizations, and that includes universities. So it identifies IP in niche business areas and then helps find the right management team to build the business out and add some capital. And those are the three things really that defines a successful early stage investment. And that's what it brings to the table.
And what is in Tech Capital's portfolio?
Well, there were 5 material equity investments. The largest is Microsalt, which is listed in London. It IPO'd earlier this year, and it produces a full flavor salt with around 50% less sodium used in foodstuffs. Sodium is a real issue and triggers many health problems. So the investment case lies upon getting low sodium products, its low form of low sodium salt, into major food manufacturing supply chains, and that's obviously a very, very large market. Secondly, it has Guidant, which is unlisted. It's a US-based remote control monitoring system for autonomous vehicles. And autonomous vehicles, we're just on the cusp of seeing those delivered to market, and that's another very high growth promising company. Thirdly, there is Bellascura, which produces very high efficiency portable oxygen concentrators for use by people with obstructive pulmonary disease. So it's a market leading product, and that's just the quarterly sales are really beginning to take off now. And lastly, there's Innovative Eyewear that's listed in the US, and that makes smart ophthalmic glasses, whereas lots of manufacturers make smart glasses, but they're not really ophthalmic based. So this has a particular niche in high grade glasses. And in addition to that, it has some convertible loan notes where it's actually, rather than put equity into the business, it's put a debt instrument in as well. So all those 5 equity investments plus the loan notes make up most of the 70 million net asset value we've stated as at June.
And finally today, what do you think could be the triggers for a re-rating?
So I think there's a couple of triggers we can identify. Firstly, the underlying equity investments themselves beginning to perform, and we can see quarterly revenues really beginning to gain traction now. And as those companies move towards break even and into profitability, that's really the trigger for the share prices themselves re-rating. But also there's the macroeconomic effect of higher interest rates. And it's conceivable that we're entering into a lower interest rate environment now. We've already had 1 cut from the Fed. There might be more later this year. So those 2 things, the underlying performance of the share prices and the lowering of interest rates, should help lower the discount or narrow the discount at which the tech capital shares trade towards fair value. And I think there's substantial upside possible in the tech capital share price.
Simon, thank you so much for your time today.
Thank you very much.
And thank you for watching Flagstaff TV.